The following is a presentation of TFNN. It is now time for the Tiger Technician Hour with your host, Basil Chapman. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Basil Chapman.
The Tiger Technician's Hour. Dow's down 137 at 16,853. S&P's down 14 at 1950. Why was I so negative over the past couple of weeks? Why have my subscribers been on the dark side for quite a few weeks? Because those weekly charts, even though this is just midweek, they're giving every single sign of that pattern that I look at that I call the double hump camel pattern, but in fact it's the right shoulder extension that pulls back sharply. And that very often concludes a very, very powerful move to the upside. If nothing else, you could be at least a bit cautious here. I had some requests in the den just while the break was coming up, as from Steve's show, terrific show. Thank you, Steve. We have programming right from 8 o'clock here. You've got John Logan the first hour. You've got Steve for 2 hours. You've got me for an hour. You've got today, you've got the options hour. You've got Daryl Martin. You've got Dave White. You've got, I'll be doing Tom's show between 3 and 5 today. Tom will not be in. And I was asked if I can do it. It works out perfectly for me. Today, I actually have that time, so it's just fabulous. And it's an honor, of course, to be able to sit in Tom's shoes. Big shoes to fill, but we'll do our best. And then, of course, you've got Andy Hecht at the end, wrapping up 5 to 6. I mean, this is program deluxe. So let's go through the numbers here. You've got the comp index. Now, look at this. Yesterday, the market soared at the opening, and I had a signal that said that there should be a rally given Friday in the Chapman Wave Chin Gauge, special proprietary technique that I developed many years ago, that said that there should be a rally within 2 days, and it should go from the futures into the cash S&P, and then at that point we should be seeing some kind of a pullback, and that's exactly what happened, of course. Then yesterday I had another technical indicator that I use, and that's called the Chapman Wave Trend Gauge as well, but it uses a different number on the trend. That's the short-term trading index developed by Richard Arms. I have nothing whatsoever in the least to do with Richard Arms' analysis. It's just a fantastic indicator. I happen to use it completely differently. Whenever I hear Richard Arms talking about it, I say, gee, I don't do that. I don't do that. I just have a terrible habit of taking technical tools and then making them my own. I say terrible habit because it's a little embarrassing when I'm asked about the technique as it pertains to the original source. I stumble and fumble, even though I've read it maybe 1,000 times, because I've already moved on to my own technique. So it's always a little embarrassing. But that particular technique that said that today we should see a rug pull, and then we should see a rally that should fail. Well, so far we've had everything that was required of this index. This is a fabulous tool. It has, I don't know, it must be a 96% accuracy rate. So let's move on, because there are other tools that are very important. If you're looking at the comp index, it went to a peak D in the Chapman Wave, made a C1, C2 double top. Those of you who know the Chapman Wave methodology, you know what that's all about. And then what happened is it pulled back and then popped up one more time just to complete that leg D to the upside at 4610.57 on the 19th. That's where most of the indices made coincidental highs. That's really unusual, and pulls back very sharply from that level down to the recent low of 43.67. Had 2 days of a very strong move up. Yesterday it went all the way to 44.96. Today it's way back down at 44.21. I am really cautious, and I'm going to explain why. Look at this composite index chart. Now, there was a question, would the composite index in this an alternate count go to a peak D? Well, you know what? It used that exact same technique that went to a peak C1 right here at 100. I'll see you right now. It went to It went to 4610.14 the week of the 5th of September, and then lo and behold, pulls back, touches the 9-period moving average the same day that it hits 4610.57. Oh, wait a minute. It went to that D. That wasn't even a C1, C2. Oops, here comes something. So that's a C. That's a regular peak C. And I never had a chance to do that before. I'm looking at it and went to a D. That's what you want in the Chapman wave methodology. And now the MACD is negative. Stochastic's under 80%. It closed last week under the 9 EMA. Very ugly candle. I should not ever consider putting a down arrow before the week is up. So I'm going to put a plus sign here and say every single thing about this chart says that it should close, the composite index over 2,000 stocks should close under the 9 EMA, which is at 44.88, and the price right now is 44.24. I'm not sure what can give it 60, 64, 65 points at this particular point to close above the 9 EMA. And as far as I can see, this is a very negative, potentially very negative weekly chart. The daily has already gone from a sell signal to a sell mode, and the weekly, I can only say that technically it's at a sell signal, but it might make, as the S&P did on Friday, it might make in 1 week a combination, a sell signal that immediately gets upgraded to a sell mode. Don't mess with these charts. Look at this. This is the weekly, the monthly. The monthly has walked the 9-period exponential moving average. This is the big composite index. It went to a peak D the last time in the Chapman wave back in the 5th of May of 2011 at 28.87. Pulls back for about 6 weeks, 6 months or so, and then it starts a brand new move. October of 2011, it goes peak A, B, C. And unlike many of the other indices, which have recycled to a brand new ABCD to the upside, this is D, and it went to an E. And this month, the whole of October, it has to break above 4610.57 by 1 penny to extend this move up. But if it doesn't do that, it's made a peak E. And look, the MACD is still very strong, but heading towards closing negative if it continues down like this, if it goes under 43.25, which is the 9-period exponential moving average. And lo and behold, the stochastic, which is at 93%, hasn't given a single signal, but the relative strength index and the Chapman wave analysis of peak A, B, C, D, D in the unbalanced volume, that blue line says it's struggling to make a new high. Watch this one real closely. But that camel hump, look at this. The camel hump. I love that. All right. The SPX is right in that circled area. I had a call from John in Philly a couple of weeks ago. He said, where do you think that the S&P would go if it was going to decline? If you think it's in a sell signal that could go to a sell mode in the weekly, where do you think it could go to? I said, wait a minute. Let's see that up channel, the inside track of the up channel. I don't know why I've got 2 of those. I did that the other day as an experiment. What I'm going to do is make that a dashed line. Right. And it's and I circled right in there, which starts this week, goes into next week and the following week to hit this very, very important support line of 1938 in the S&P, cash S&P. That's the S&P 500. If it takes that out, watch real closely, because if in October the S&P goes under 1920 to 1980 support, 1912 to 1904 would be the next level of support. In fact, 1904 was the low back in August of this year. And then you started that big move up that usually gives you 2 peaks. This is the one that we had back in 2000 and, I wonder if I've got it here, 2007. Let's move back here. So this is October. Oh, I haven't got this one notated because I've had it notated so many times. Yep, there it is. And this one went, okay, this one went to ABCD. So let's go to the Dow, because this is the one that was really important. The Dow is INDU. Let me give you the numbers as well while we're going through this. Back in 2007, wow, I got to renotate all this stuff. That was the move up. Oh, that went to a D, but it was the same. Oh, that's right. This extension A to B right there is what I call that camel hump. There's the single move up in the stochastic that turns around immediately after going to 80% and breaks down. That's the one that you've got to watch real closely. Dow's down 146. S&P's down almost 15. Composite index is down 36. Gold, at this particular point, the GLD is at 116.42. It's up 39 cents. But gold itself, I'm a little behind, is up 3.40 at 1210.70. And silver is down 3 cents at 17.19, going to be really important. Bonds are at 140. Now, what's really important about the bonds, look at the TLT. The TLT is on its way to start leg C if it can cross 119.43 in the weekly, and it's already started leg C up in the daily, and the daily has right there a left side, right side price time match would went to yesterday, so it's a little bit behind, but 119.43 is the move. With the MACD very strong, stochastic still very strong. Now look at this. This is the dollar. You know, currencies don't turn on a dime. Sorry. Currencies invariably continue for a very lengthy period. Look at this lengthy period. Look at the way the dollar has gone from 78.91 the week of the 9th of May back in 2014, this year, and then broke out, went to a peak A, then to a peak B, and has gone to this incredible leg C. And look at this. If I show you the weekly chart, you will not believe. Well, if anybody was short, they'd believe it. But if you were long, you'd say yes. Look how it broke out above that peak F top in the Chapman wave from back in the week of the 12th of July, 2013 at 84.75. This is the index itself. So this is a powerful move. It's had a pretty sharp pullback so far based on the chart pattern of the weekly. But look, the stochastics at 97% and the MACD is still very strong. So far, it's saying that the dollar could pull back, but the internals of the weekly and the monthly are still extremely powerful. So that to me is really, that's the statement here. Now, what I'm going to do is I'll just quickly, as we're about to go to the break, I'll run a couple of things here. And one is I'm going to do the QQQ series. That's the NASDAQ trading vehicle. This is the trading vehicle of the NASDAQ 100. I'll do this in 4 time frames. I'll put this up right here. And now look what happened. 1, 2, 3. You've got the QQQ series breaking down. Couldn't break that resistance line yesterday. They're trading at 97.20, down 74 cents. And here is that peak T that was made in the weekly chart. Hey, folks, be very careful out there. This could be more than just a daily pullback. This could be a weekly pullback. If it's a weekly pullback, this could then affect the monthly. I'm just very cautious. I'll be right back. Basil Chapman, back to the show. That was down 150. And I'd love to take 877-927-6663.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
With the launch of Tiger TV, TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing. Basil takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Folks, because I moved on during the break, I have no idea where I was just earlier on, so let's just do this. A question of the day, and I think this is a very valid question by Joe. Would you please look at SCO and or DAL? And DAL is Delta Airlines. Now, this is very important to me. The XAL with crude oil plunging. I mean, this is the first time in ages we've seen crude oil really take it on the chin. I'm getting signals here in the airline index, the XAL, to say that this could turn out to be a little bit more serious of a top than all those people that were saying that the airlines are the best place to be. Because as I see it right now, the weekly chart is failing, and if it takes out the low of last week of 77.47, it's at 80.24 right now. That's over 3 points. It's the way to go. But if it takes that out, that monthly chart is going to deteriorate. So that monthly chart needs to see by the end of October some kind of consolidation and then a bounce back to at least get midway towards the 84s, and certainly the XAL, which is the ARCA airline index, as I see it in the daily chart, is making that H pattern and has tested the 200-period exponential moving average, made a peak D in the last high at 88.98. So when you look at Delta, it coincides very well. In fact, it's done almost the same. Look, peak A, B, is that a B1 or B2? It's 40.77. Come on to 78. Oh, it missed it by 1 penny. So it goes to a C, which becomes a C minus. It really looks like a D. It has every characteristic. It fell by a penny to make a leg C there. And now it's testing the 200-period moving average. It's made a peak F. That's the sixth highest peak in the monthly chart. That is where you got to be careful, and it's making the H pattern that I call the dreaded H pattern in the weekly. So if Delta doesn't bounce to 37.50 and then start to move even higher over the next 2 weeks, but instead takes out 34. It's only 3.5 points away from your 10%. That's going to be really poor action. That's the one. The SCO, which I haven't followed for quite a while now. In the weekly chart, this is the 200%, I think, is it ProShares Ultra Short? I can't remember. Is this 200 or 300% short? Crude oil has gone to leg A, B, C. It's in leg D now in the weekly. And that's the biggest move it's had in quite some time since it came down back in January at a double top to peak C1, C2, went all the way from the 36 area down to the 24 area. And that weekly chart, the monthly chart, is just starting to build some strength. So that's saying to me, watch this crude oil, because crude oil could be having a far more serious pullback, and that gives strength to the dollar, or vice versa. The dollar's giving strength, gives internal weakness to the oils. I'm just saying, please, please, please don't get too. If you have wonderful profits, I'm already just recommending, don't get carried away. Don't drive into a tree or whatever. I almost did back in June of whatever year it was when I was listening to one of the prognosticators talking about so bad that he had already built up a basement of stored goods. Just go one step at a time. Take a little money off. There's nothing wrong. You've had a fantastic move. Just prudence says money management. Take a little bit off. Maybe put that aside. You'll put it back in the stocks that have treated you really well. Keep your core positions, and then have you could put in staged stops. Just spread them out in different areas, and even different times. You could say, I'm going to put a stop over here, and I'm going to put it in for this week, and in 4 weeks' time I'll put it over there if it hasn't hit, or it could be just the price. It doesn't matter. Just be a little bit careful. What we're looking at right now is bearish activity. You remember what I said is that all news, look at the good news that's coming out. I said when good news gets taken as bad news, and the volatility, those are the only two criteria you could have had in this entire bull market, and I regret that I didn't always listen to myself. If you had just used the volatility index, which right now is at 16.65. Remember I said in the high 15s, in the mid 16s, watch out. It's going to put a tremendous amount of selling pressure on the market. So what we've got here is that crude oil, the 120-minute chart shows peak A, B, C, peak C, peak D, and it's still rallying. And the last 120-minute chart went peak A, B, C, D. God, those Ds are just amazing. Use them and look at pullback, and then the quicker it comes back from a D, it says the quicker it could go higher. So this is where you've got to be really, really careful. Crude oil is pulling back, and yet the XAL, the airline index, is pulling back. Okay, enough with that. Now, the next question I had was, so Delta, the question about Delta is I'd be very careful here. I'd be taking some profits in Delta if you have them. Would I short? You see, those are two separate questions entirely. Would I be shorting Delta here? My answer would be I would have preferred to have done it yesterday, where we reinstituted shorts in my opening call. Here, yes, I would, but it would have to be a different position. In other words, it would not be a full position. It would just be like a small position right here on Delta, and it would be with a fairly tight stop, because I would like to see the down. Or it's going to move immediately down. I'll be right back. Basil Chapman, outside 157, it's down 16.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Andy Heck's powerful weekly newsletter, the Technomental Commodity Report, has delivered multiple triple-digit winning trades in recent months. And right now's the perfect time to get a full month-long trial to Andy's newsletter with no obligation to pay anything. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you'll lock in the low rate of only $59 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. Just let's go straight to this. I was supposed to do it before. I had a question by Oda in the den about the 5-year notes, the $FVX.X. It's the cyan-colored one right there. And look what it did. It's in a slightly rising up channel. It's really an asymmetric triangle, but let's call it an up channel. And there could be parallel lines right there. So it's in an uptrend, making slightly higher highs and slightly higher lows. And now it's turned down. It's at 16.50, 1.65%. Okay? It had a low of 0.541% way back in July of 2012. It barely made a new recovery high. But wait a minute. The 10-year has gone to a trough D in a counterpoint move, making lower lows, had a bit of a bounce, and is now at 23.75 when the last low was 23.05, 2.305. Number one. This is a very important factor here. This inverted V-shaped pattern is something to watch really closely. This is the weekly chart. I call it my chart. I show my subscribers to my opening call every week. Most weeks I show it, or every 2 weeks. And I show this because it shows you the 30 here, which went to an unusual peak G at 39.74 early this year, pulls all the way back to 30.59, has a strong bounce in a single leg A up, and is now so close to 30.86, just testing the 30.59 level. Now, let me just show you something. I wonder if I can grab this chart. No, I'll just take this chart right here. Let me just show you something. This is now the volatility index. I didn't want that. I want to show you something. This is just a naked chart. All it's showing you is a chart pattern. This particular chart pattern, where you go very quickly in a single leg A, it happens to be an A to a B, but it's basically a single leg up, and then it comes all the way back. I call it the Eiffel Tower, because it's like a capital A. It's like this pattern right here. A. Let's just go to the format text. Let's go to font. Let's make it kind of big. 48. Yeah, you see it's straight up and straight down. But if it doesn't take out the low, or even if it just takes out the low and closes above it, that's like an arch formation, test of the H pattern. And if that holds, you can sometimes have another powerful move to the upside. I want you to show you this chart for one reason. Because if you're looking at the bond yields, and these are the yields, this is the 30-year, the 10-year, and the 5-year. See how the 5 years differed completely. At one point, you were getting an expansion where they were moving, the price of the yields were moving away from one another very sharply, especially over there. Then all of a sudden, they've started to come together. Now this is the closest that they've been. They're not overlapping, but they're getting close. The last time they overlapped was way back here. That was in June of 2007, 54.08, right there. Look at that cluster pattern. Well, have a look at this. All of a sudden, you've got that inverted A that goes up and then down. Sometimes, if it's at lows, and this is not at a low, but it is at a low, not the low, way back at July of 2012, you can get another big move to the upside. So this is going to be really important with yields, because is money with the TLT up at 118.66 having to break that 119 point whatever it was, 52 or whatever it is, to start another leg up. If, in fact, money is going to flow out of stocks into the so-called comfort and safety of bonds, then those yields will be coming down. Now, when I look at the way this is clustered together, with 30.85 in the 30-year, 23.75 in the 10-year, and 16.48 in the 5-year, I'm saying to myself, this last peak D in the 5-year is saying it was such a struggle to get there that it could quite easily pull back to the 14.95 low that was made the week of the 15th of August. And if it does that, you will see instead of a bounce in the yields will continue down, and you will then see bonds moving even higher. Now, I'm going to put that together because this is a very important period for both the dollar and gold, only because if ever there was an arch formation that retested its low, gold just did that yesterday. It went under and it closed above it. So that's the opportunity for that H pattern to have a push to the upside. But look at this. I don't often show this particular chart. I usually just show my subscribers, but this is so important. Let me show you something. Here is gold, continuous contract. It broke its downtrend line, and all it's doing is making that lowercase h that goes to a lowercase m pattern, and it should retest and break under the, this is the continuous contract. So I'm going to give you the price, but it isn't the real price. It's right now, see, gold is at 1228, and I've got gold, the GLD. Where's my gold? Let me just give you, I want apples, the apples as close as I can get it. And gold right now is at 1211. Can't even remember what I just said. Okay, so within 4 points, right? So this goes all the way back to the lows that were made back in June of 2013. And I suspect it will break that low at some point. And I said probably November, maybe December. That's kind of what I was looking at. I don't know, but I'm looking at this as saying we could be getting closer and closer to some kind of a pretty decent bounce if the dollar starts to pull back, but we have to wait for that. Look at silver. Silver's been in an uglier pattern. It's very, very weak. this is the monthly chart, so anything can happen in the dailies. This is the monthly. Look at copper. Copper's done the same thing. It's actually been, in some sense, it's even been weaker than silver. But it hasn't gone near the most recent low, and that's the low of March of 2014 or the low of July of 2013. Look at platinum. Platinum is, in fact, breaking to lower lows, and that's part of that whole automobile industry, I believe. And look at crude, about to test those lows at 89. This is the continuous contract, 89.39. If it breaks, if the crude goes under 87, you would expect that the XAL, the airline index, would really be improving. So we've got to watch this very closely. So why do I say it's a very important moment? Because bonds are saying we're real close to testing or breaking the most recent low in the 30-year. To me, that's very important. The 5-year is important for a different reason. 10 years is important for another reason. All three have different reasonings behind them. So let me go back to my natural white background charts, and you can see, look, there's that little bit of a rally starting up on that on this pattern. Naked chart, 10-minute chart of the E-mini. This is going to be very important. Here's another, this on a short-term basis, very near-term, I should say, basis. Now let's go back to the dollar, DXY. This is the dollar index, holding the 9-period exponential moving average in the daily. The 120-minute chart is not great, but is trying to form some kind of support level as there's a positive divergence between the stochastic and the price. MACD is trying to turn up, and the histogram, the red lines, are starting to improve again. Let's put that together with the USD JPY, which has been in concert with the dollar, moving higher. It has failed right here. It was doing beautifully, went to leg D, and now this is probably going to be a peak D in the weekly chart, went above the 9-period moving average, the 200-period moving average in the monthly chart. First time it's been there. Oh, man, look at this. First time it's been there since, keep squeezing, since, oh, my goodness, since, keep squeezing, have I even got it? Yes, since 1985, January of 1985 was the last time that, or February of 1985 was the last time that the USD JPY currency pair tested the 200-period moving average. That is, it touched it. It's gotten close, but it's been repelled every single time. This time it went above it. So that is significant, and it's saying that the USD JPY, the monthly chart still has internal strength. The weekly chart is very strong at this particular point. We've got to watch this daily because it's making that H pattern, lowercase h pattern, must hold. I don't think it's going to. Must hold 108. And if that goes, then you're going to see the dollar pull back probably a little more because they've been moving in concert. And the dollar made peak D, but it's only leg C, possibly peak C in the weekly. And that says the dollar, which just touched for the very first time in a long time, the 200-period exponential moving average, first time it touched it since it broke down back in 2003, March of 2003. So they kind of going in the same direction. I suspect that that should continue until it doesn't, and then right now it seems to be continuing. So we're going to be watching the currency pair, the USD JPY. Now have a look at this. This is the EUR USD. This is the euro-dollar currency pair. This, in fact, has gone to a trough G in the Chapman wave. There's a very positive divergence between the slow stochastic starting to rise, but still under 20% at 17%. But the MACD is possibly about to cross positive. It is a brand new leg B to the downside in the weekly, having made a peak F at the recent high. But what's important is that the stochastic in the weekly is at 2.94. That is the equivalent of when we've been seeing for months on end, weeks at least on end, we've been seeing these prices with a stochastic up at 96%, 97, 98%, stays there for a long time. So this is the level where we call positively induced buying, and in this case is positively induced selling pressure in the euro-dollar currency pair. So I needed to put that together. Maybe it's a little too much information. So let's go back to some charts over here. But in the meantime, back to the ranch, the reason why this week is so important, because if the dollar does pull back, we should anticipate that the GLT and gold itself could rally. If gold doesn't rally, it is saying that there is just so much intensity in the selling that gold is not a participant on any rallies at all, and that we've just got to exclude it. You just got to say, sorry, gold, you're out the picture. You've tested the left side low bar in the weekly chart. You've had a very nice pop up above it, right there. That's that low right there, the one that went to 1.0. Is that the euro? Yeah, no, that's gold. 1,283.80 back in January, the week of the 3rd of January. And it had a very nice move to the upside, failed at a B minus, failed at an A minus, comes all the way back. That's what you expect. It's retesting it. But wait a minute, is there another low on the left side that we need to be aware of? Of course there is. There's that low that goes all the way back to the Roman candle of Chapman Wave Roman candle of the week of June the 28th of 2013 at 1182.30, where 1182.30 is only 1183.80. It's only $1.50 below, but it is the most significant lowest left side low bar that we've got to focus on. Okay, so to me, there could be a bit of a pop-up in the gold. On the weekly chart, it has to cross in the weekly chart above 1237 is the 9-period moving average. I just don't know if it's going to do that. And remember, currencies don't just change on a dime. Something's going to happen with the dollar. And if my weekly chart is correct in being leg C, there should still be a D to come. So this is why it's such a fascinating week. Not only that, I'm talking about the Dow. Look at this. Let me show you something. INDU. And there we go. Look at this weekly chart. This weekly chart, let me give you the clearer weekly chart right here. This is the one I usually use for analysis purposes to show publicly. The other one is the one that I use for myself. This one right here. The other charts all go to this, not this one. This is the one that I keep for the dollar because look how clean it is. I just didn't want to take off all those pieces of information that I've built up on the other chart about the stalk leg formation, all that, because people are studying the Chapman wave all the time. You see, this is that double camel hump. Look at the way the MACD deflected lower. Look at the way that right arch formation in the stochastic has gone over 80% and then failed. Look at the way invariably this particular pattern gives you just two peaks to the upside. One is invariably below the left side high, which is at 17,151. This one happened to go to 17,161, and then it pulled back and it went to another leg up. So I'd say that in my analysis, I'm not willing to bet anything. I'm willing to discuss the fact that that isn't F, that's actually an E through a phantom peak. This is really the F, and this is really the G. It has every single bit of information that I'd be looking at to consider that this is a pullback of serious consequences that is going to test the up channel inside track, and it has to hold 16,666. A break under 16,666 says, 16,333 would be next. So, whoa, that was a lot of information. So now, let me do something else. I'll take this chart away. I'm going to go back here, and I'm going to show you the S&P, which is much cleaner. Now, in my opening call, we are short the S&P. We've been short from almost the exact top via an instrument that is 300% short. And so far, I think it's going to work. I don't know for sure. Look at the way the MACD is. This is the exact opposite of bullish. This is bearish. The MACD has a wide beta between the green line, the 9-period differential, and the red line, the slow-moving average. It also has the stochastic under 80%. But remember, I based it a lot on unbalanced volume. When you learn how to use, that's what I love to use my courses. When you learn how to use unbalanced volume, it can just be that very quiet tool that nobody else uses. Nobody, well, people might use it now, but it just gives you a heads up. It's like a yellow light that flashes. I'll be right back.
You take a hands-on approach to managing your investments. And whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
We're back. And remember that pattern that I was just talking about, that A pattern, uppercase A, that looks like the Eiffel Tower, straight up, straight down, and that it can often give a really good bounce. Look at this. There it is. Right there. I mean, right live you saw this. There it is. No notation. I put nothing. Not even letters. Just the pattern itself. So now look at this. That's what I'm saying about bonds. If perchance bonds have that same pattern and they hold well, that's why it's such a very important week. My thinking here is that this is a lot more complex and that it might not match the same kind of pattern. Test the A successfully and have a very strong bounce. But this is what we've got to watch for, because if money fails to come out of bonds, fails to come out of stocks, stays in stocks, and doesn't go into bonds, and in fact bonds then are free to drop a little bit, and yields can go back up. So I'm going to be watching this real closely. At this particular point, I expect at least a test of the 30.59 level in the 30-year, and that I don't think we'll get all the way just yet, all the way down to the 23.05 in the 10-year, and certainly not in the 5-year to the 14.95. Not unless there's some wiggling up and down first. That's the way I'm looking, or at least time. I just don't think it's going to happen in 1 week. You never know. Okay, so we're about to go. This is it. Let me just wrap up here because we've got Options Hour coming up. Just great show coming up with Chad. So let me go through this again. I didn't get to Goldman Sachs. I'm watching that really closely. I'll do that tomorrow. The VIX index. If the VIX index continues holding and making higher highs and higher lows, if by Thursday to Friday of this week the volatility index has even gone testing the 17s, this is not a good sign for this market. If suddenly it falls and goes back to 13.56, I have to say, you know what? Selling is less intense right now. You could have a better rally. Guild, I don't see the break just yet. So Guild is Gilead Sciences. Question is, what would I do right now? I wouldn't be shorting it just yet. There is just enough residual strength, but I would definitely be taking some profits off. If you've been in a long-term position, I'd be taking something off. I'd keep the core, but if you got the core, it's at 104.91. If at any point in the next week and a half it closes under 99.23, if you've got a core, then 4 points shouldn't make such a big difference. But if it starts to, I would start lightening up. In fact, I'm going to make it a little bit even more delicate than that. I'm going to say if it goes to 102.20, I'd lighten up a little bit more. Okay, I don't want to change your core position. You were the one that got it and was fantastic. Would I short it? I'd be waiting to short it. It's one of the strongest in the sector, and the IBB is weakening all the time. And I think it's made some kind of a top here at 279.55. So now let's go back to the market. So IBB, away was a question. Away, I would also be taking some profits in away, home away, Inc. trading at 34.89. I take a little bit off, and I'd raise my stop on the call. That's all I would do this particular time. It's acting quite well considering the market. Now, the Dow, IND. The Dow at this particular point is showing signs that it wants to retest this candle, the candle of the 2nd of December, making a low of 16,674. In the next 2-3 days, if it breaks 16,666 support, I would say be very, very careful, because we're going to be probably going all the way into to the 3rd to the 4th week of October to the downside, if that's the case. If for what I don't think it's going to happen, but if there's a rally that takes us over yesterday's high, which was just an aberration, there shouldn't have been such a move up above 17,099. If the Dow is trading at 17,120s. I'm going to have to admit it's held beautifully, and it could squeak somehow or other towards the all-time high of 17,350. Let's do the SPX at the same time. S&P 500. This is not a great-looking chart in the daily. It's trying to make a rally. It can't. I'm watching this closely. But the S&P, a break of 19,143, I'd really careful. Folks, check out my opening call. It's my daily service. It's a lot of information we're adding to our positions every day. So it's a good time to check it out.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
This is TFNN.